Trading futures on Bybit offers a dynamic way to engage with the cryptocurrency market, providing opportunities to profit from price movements without the need to own the actual assets. Futures contracts are financial agreements where you agree to buy or sell an asset at a future date for a predetermined price. This allows traders to take advantage of price fluctuations, whether the market is moving up or down. In this tutorial, I'll walk you through the essentials of futures trading, helping you understand key strategies and how to analyze charts effectively so you can better navigate futures trading. Before we get started, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss our latest updates. To trade futures on Bybit, the first thing you need to do is create an account. Bybit is one of the top platforms for cryptocurrency futures, offering a seamless trading experience. Once you have set up your account, you'll find that the platform supports a wide variety of cryptocurrencies. Futures trading on Bybit enables you to speculate on the future prices of these digital assets without actually owning them, which is perfect if you're aiming to leverage market movements to your advantage. It's also worth noting that Bybit provides an excellent referral program. By using my referral code, B5QJY or 18499, you will receive a 20% discount on all your trading fees, which can add up to significant savings over time. I'll also leave the referral code in the description below for easy access. Now, when it comes to trading futures, it's important to understand how they differ from traditional spot trading. In spot trading, you directly buy and own the asset. However, in futures trading, you're dealing with contracts that allow you to speculate on the future price of these assets. This gives you the potential to profit from both rising and falling markets. Futures contracts on Bybit can be either perpetual, meaning they don't have an expiration date, or they can have a fixed expiration period, such as quarterly contracts. The most exciting aspect of futures trading is leverage. Leverage allows you to control a larger position than the amount of capital you invest. For example, Bybit offers leverage up to 100 times, meaning you can amplify your potential profits with a relatively small amount of capital. However, leverage is a double-edged sword. While it can magnify your gains, it can also amplify your losses, making risk management crucial to your success. Now, successful futures trading hinges on applying well-thought-out strategies. One of the most commonly used approaches is trend following, which involves identifying the overall direction of the market and trading in that direction. This approach helps traders capitalize on upward movements or take advantage of declining prices by aligning their trades with broader market trends, thus avoiding the risks of going against the tide. Another effective strategy is breakout trading. This method revolves around spotting key levels of support and resistance on the price chart. Support is a price level where the asset tends to find buying interest, preventing the price from falling further, while resistance is where selling pressure might stop an upward move. When the price breaks through one of these levels, it often signals a strong move in that direction, and traders can capitalize by entering a position right as the breakout happens. For those who prefer shorter time frames, scalping is another approach to consider. Scalping involves making multiple trades throughout the day, each one aimed at capturing small price movements. This strategy requires speed and precision, as you'll need to react quickly to even the slightest changes in price. Scalping can be especially profitable in a volatile market, but requires constant monitoring. Now, an essential skill for any futures trader is the ability to analyze price charts effectively. One of the most popular tools used for this is candlestick charting. Candlestick charts provide a visual representation of price movements over a specified time frame, helping you understand the market's sentiment. Each candlestick shows 4 key data points, which are opening, closing, high, and low prices for that period. By analyzing candlestick patterns, such as hammers or dojis, you can spot potential reversals or continuations in price trends. Moving averages are another valuable tool for chart analysis. They smooth out price data, helping you identify trends over time. The simple moving average or SMA calculates the average price over a set number of periods, while the exponential moving average or EMA gives more weight to recent prices, making it more responsive to current market conditions. Many traders use moving averages to spot potential entry and exit points, especially when shorter-term averages cross above or below longer-term averages. Momentum indicators, like the Relative Strength Index or RSI, also provide important insights. The RSI measures the strength of recent price movements and helps identify overbought or oversold conditions. If an asset's RSI rises above 70, it may be overbought, signaling a potential pullback, while an RSI below 30 could suggest that the asset is oversold and may be due for a price increase. Volume analysis is another critical aspect of chart reading. Volume refers to the number of contracts traded during a given period. A price movement accompanied by high volume is often more significant than one with low volume, as it indicates strong market participation. Low volume moves may not be sustainable, so understanding volume trends can help you assess the strength of price changes. While futures trading offers tremendous profit potential, it also comes with risks, especially when using leverage. Proper risk management is key to ensuring long-term success. Always use stop-loss orders to limit potential losses. A stop-loss order will automatically close your position if the price reaches a certain level, protecting you from significant downside risks. Position sizing is another critical factor. Never risk more than you are willing to lose on a single trade, and avoid using excessive leverage, especially if you're new to trading futures. Trading futures on Bybit provides traders with the flexibility to profit from both bullish and bearish markets, all while taking advantage of leverage. However, successful futures trading requires more than just capital. It demands a solid understanding of strategies, chart analysis, and risk management. If you're ready to explore the exciting world of futures trading, head over to Bybit today. And don't forget to use my referral code, B5QJY or 18499, to enjoy a 20% discount on your trading fees. Be sure to also subscribe and turn on notifications, because there are more tutorials on the way.